Crocs Inc. ticker symbol Crocs is currently trading at $108.43 a share. It's recently had a 20% increase. This is off their most recent earnings, and we're going to be going through those numbers right now. But if we go over the last year, the stock was trading at around about 130 at the start of November and has had a massive drop at about 34% prior to this recent increase. So what we're going to be doing is quickly going through these earnings and then taking it to my automated stock valuation spreadsheet, seeing if Crocs is a buy or sell using the discounted free cash flow model, comparable company model, dividend discount model, and Ben Graham formula for intrinsic value. So let's just have a look at Crocs. Here we have, well, we'll just go straight to the statements here. We have the 3 months ended of 23 versus 24, and we have the full year. So December 23 was 960 million, and now up to 198, and that is 3.9 to 4.1. So revenue is up. Actually, before we continue this, let's just quickly go here and put in the ticker symbol Crocs, and this will load up all the financial data, and then we can flick between the two screens and have a look at the numbers more historically, and then also the more recent year. So as we said, 4.1 billion, that is the number that we've seen. If we go revenue, 4.06, and then we flick to here, so pretty close. Then we have the profit, net income, more profitable as well, 239 to 368 million, and then that is up 800 million to 950. Cash from operating activities minus capital expenditure, that is the free cash flow. If we just scroll down a little bit here, cash from operating activities is 950. This is the full year though, so up from 800 to 950. CapEx, which is the purchase property and equipment, which we can see is just about here. CapEx is down slightly as well, so quite interesting to see here. Remember, this is the full year. So revenue, all-time highs. Net income, all-time highs. Free cash flow, all-time highs. And as we can see here, operating cash flow is up, and as the CapEx is down. Now, just talking more about the revenue, let me just go back to here. And we'll scroll down a little bit. Keep scrolling. This is the revenue by segment, channel, and geography. So we have Crocs brand, North America, international, and specific. So here we have wholesale, North America, up. We'll just look at the year ended for now, but you can see it is up. Oh, sorry, down slightly, 652 to 664. But direct to consumer is up 1.12 to 1.18. Overall, total North America is up slightly. International is up. Direct to consumer is up. And then obviously total international and total Crocs brand is up as well. Here we have the Crocs brand splits between wholesale, direct to consumer. And you can see here up. Total Crocs brand up again. Wholesale down slightly. Direct to consumer down slightly. Total consolidated revenues is up, as we've seen here, 3.9 to 4.1. So revenues is growing, that's what we want to see. So let's have a look at shares outstanding. You can see they have been buying back their shares, which is what we want to see. So finally, looking at the discounted free cash flow model, this is where valuing stocks, looking at their future free cash flows and discounting them to today's value. And let's see if it is a buy or a sell. So just before I start, we'll just quickly override the numbers here because we're not looking at the specific averages here. So currently it is $360 a share. Wow, that is a massive. So massively undervalued according to discounted free cash flow model. Let's see if we agree with these. Net income margins. I will look at profit. We'll look at revenue first. So they're expecting 4.8 and 5.7 in the coming years. See if we analysts agree. No, a little bit lower, 4.2 and 4.3. So we'll bring those revenue numbers down. As you can see here, this is kind of skewed by 21, 22. So let's bring it down to about 7%. We'll even bring it a bit more low. We'll go 4%. $220 a share. Net income margins, I think they're a little high. We'll take an average of the last few years, 23. And net income to free cash flow, I suppose that is about fair, but you can see $117. I mean, even if we take the lowest number of these of the most recent years, which is 62%, that still puts it at $143 a share. So a discounted free cash flow model really does like this stock. You can see here the free cash flow ratio is about 7, and over the last 5 years, about 12. So it is looking undervalued in terms of discounted free cash flow model. Also, actually, I didn't go through this at the start. We do look at Crocs, 6.3 billion market cap, PE of under 7. currently. Market average is around about 30, which is very high. Which is a lot lower than Crocs. Target price analysts also say it's a buy at 130, but discounted free cash flow model really does like this stock. Dividend discount model, sorry, we can't use that because it is they do not pay a dividend. So let's have a look at the Ben Graham formula for intrinsic value. This is where value in stocks looking. Which was created by the godfather of value investing himself, Ben Graham. Looks at earnings per share, PE of no growth company, AAA bond yield, corporate bond yield, and currently the AAA bond yield is 5.46, and the expected growth rate of Crocs is over the next year 6.33%. 6.33. So even with this high bond yield of 5.46, it is a buy. $180 a share, grain price of 140. So for them to be not fairly valued, it would have to be basically below 3% growth, and we're expecting higher than that. So that's excellent. So let me just make this full screen again. So a buy on 2 of the models here, discount free cash flow, and Ben Graham formula for intrinsic value. So finally, we'll have a look at the comparable company model. This is where value in stocks looking at their competitors of similar industries and sizes. And we will be looking at the revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book, PEG, EV to revenue, EV to EBITDA, PE, and forward PE. So I think we will look at Nike, ticker symbol NKE. We'll also look at XKX, which is Skechers, and finally Shoe, which is, of course, well, that is load, Steve Madden Limited. I think these are pretty comparable. I did do some analysis to see what. And if you're interested in the sheet, please check my Patreon, links in the description. Let's go back here. Enterprise value, Crocs is the second largest. Nike obviously being the biggest, and Skechers. Revenue, second highest, second smallest. Revenue, second smallest. Revenue growth rate is the highest, 27% over the last 5 years. EBITDA, 1 billion, higher than Skechers, interestingly enough. Net income, more profitable than Skechers. Obviously only Nike is higher. Profit margins, higher margins than all of them. Price to sales, market average is around about 3. All of these are around about lower than that, but you can see Crocs is lower than Nike, which is good. Price to book, market average is around about 5. All lower again, and Crocs is lower than Nike, which is good. PEG, Peter Lynch's price to earnings growth. It's a minus number. I'm not sure why that is, but you can see here we want this under 1. And the minus number is under 1, but I wouldn't take too much stock in that. Maybe there's a calculation error with how this is got it, because it is getting the PEG ratio directly. So, yeah. EV to revenue, EV to EBITDA, PE, and forward PE. EV to revenue towards the top, but still lower than Nike. EV to EBITDA lowest, PE lowest, and forward PE lowest. So a buy at $187 a share. So that is quite interesting to see here. So all the models do put it quite similar. 180 on the Ben Graham formula, 187 on the comparable company, and also somewhere in the region of $140 a share on the discounted free cash flow model. And just also as well, if I was to compare against Nike directly, ignore the colors here, but that would put it at $196 a share. So it is a buy on all fronts, which is quite interesting. Rarely we get all the models agreeing. So this stock has had a bit of a dip recently, and it does look like this is the right time to buy. Right guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. Check my Patreon. I'll catch you guys next time.